Hey everybody, welcome back to another portfolio review explainer video. So in a minute, I'm going to share my screen, walk you through a sample mock portfolio. This is made up. So this is a imaginary person. This is my dog, Bush Sherman's again. He's back and wants to kick the tires on his asset allocation. We'll be talking about risk, exposures, active bets, just being more intentional with your asset allocation and truly understanding what you own and how it reacts during both sides of the cycle. So I think this is relevant for today's squirrely markets, and I hope you get something out of this. Okay, so you can see Bush Sherman's, which is my little Lasso OPSO. Again, this is a made-up portfolio, but it's nice because we have a trust, which is a taxable account, and an IRA, which of course is tax deferred retirement account. So it's good to have both sides of the coin here. And again, I'm just going to get into some of my observations. I think this portfolio is a good example because if I was to create an average prospect portfolio or an average investor portfolio, I think that there would be a lot of overlap with what I'm about to show you. So let's get right into it. So first, what I like about this portfolio is you can see by scrolling down, again, you can see the holdings here. I can make this a little bigger if you'd like. You can see the holdings here. They're all individual stocks. So there's no mutual funds. There's no, other than this Chevron, it's a small percentage, but there's no really dividend payers in this portfolio. Some of these companies pay a modest dividend. That's not a big deal. And you might be saying, Nick, but why do you have a problem with dividends? I don't. They're just really tough to own in a taxable account. So if you're targeting income strategies that are taxable, like dividends, don't do it in a taxable account, because while dividends are fine, it's a way to return capital to investors and shareholders, but they're not tax efficient. So there's no way for a professional investor to shelter dividends from taxes. So you want to own them in your Roth IRAs, your traditional IRAs, your 401k accounts, because those are tax advantaged. You're not being taxed on dividends. Many of you have heard me say that before. I just want to qualify that for our newer listeners and watchers. And then in the IRA, again, no mutual funds, no exotic alternatives, no structured notes, no expensive assets, meaning expense ratios through the roof, more than 1%. There's none of that. So this is a very clean asset allocation, clean holdings page. I like that. If you own mutual funds or any exotic assets, you're paying for them, even though you don't know it because it's not obvious, but not the cleanest way to own stocks or bonds or any asset class, really. Now for what I don't like, okay? And if you can see this page, you probably know where I'm going with this. But you can see there's just a lot of redundancies. This portfolio is taking a large active bet on technology stocks. So the big FANG companies, the big tech companies, whatever you want to call them, this is heavily invested in tech, which is fine. When tech does great, which it has the last 10 years, this portfolio is probably going to do well. When tech does not do great, like 2022, you're probably going to get crushed and trail the broader markets, which is what's happened to a lot of people. So the IRA is not as bad. You can see there's some energy. So they're taking a big active bet in energy, which again has worked out decently over the last 6 months, not so good over the last decade. And then they have a decent amount of exposure in some of these EV companies, so electric vehicles. So usually it's Tesla. This time it's Rivian. I think there's one more in here. Nikola, which is another one, and then just kind of a random collection. You can see FANG, the big tech companies, are still represented here, but not as egregious, although they do have a information technology ETF. So getting into attribution and sector weights is kind of beyond the scope of what I wanted to do now. But if I was to upload this into one of our more sophisticated tools and compare that to the S&P 500 sector weights, again, this would be taking a large active bet on technology and underweight every other sector, okay? And that might be intentional. In my experience, I find most people, it's not intentional. So they're taking more risk, they're seeking more risk than they set out to, and they're taking very large active bets that are not intentional, which again, in good times, you probably wouldn't notice, you probably wouldn't care because tech has done great. In not so good times in 2022, you might be pulling your hair out, you might be confused how this portfolio, which has been a juggernaut, is down by 15 or 20%. Okay, so it's okay to make active bets. It's okay to overweight a certain asset class or sector, but you want to be aware of it, okay? And again, this is a common theme today because humans tend to chase performance. They tend to want to own what's done the best. I've had people tell me they look at their 401k and they shovel money into the best performing funds. Empirical evidence suggests that's probably the worst thing to do, but it's human nature to look for patterns, to favor what's done well and shun what's not done well. And investing pretty much works the opposite way. Markets move in cycles, things can ebb and flow, and what is in favor can move out of favor. What's out of favor can move in favor. And in a perfect example of that is, again, 2022, where energy, no one wanted to own energy stocks over the last decade. And energy is the only, as of this recording, is the only positive sector in the S&P in 2022. And we're getting clients asking about energy stocks. Well, no one was asking about energy stocks in 2012 or 2015 or 2019. Most people are asking about them now, okay? So things can flip-flop quickly. And when you overweight what's worked, eventually it's going to catch up to you because, again, markets move in cycles. And a good example of that is what's happening to tech this year. And again, I'm not picking on big tech. It's just a common overweight that we see. It's recency bias, performance chasing, whatever you want to call it. It's there. And I just caution people, you can own these companies, you can like them, you can use their products, but given the sheer size of these companies, over $1 trillion market cap, multi-trillion-dollar market cap. I mean, we're talking rarefied air here, and it's really hard for a company that size to double over the next 10 years, let's say. I'm not saying you can't get market returns, expect 7 or 8% a year in those companies, give or take. But if you're expecting the 20, 30% returns each year that some of these companies have printed in the past, you're probably going to be disappointed. So just a token there. So another thing I've noticed in this portfolio, this is not uncommon for investors really across the world, is there's definitely a US home bias, a home country bias, where a home country bias is if you're a US investor, you just own US stocks. If you're a Canadian investor, you own Canadian stocks. If you're a Swedish investor, you own Swedish stocks. So people tend to buy what they know. Again, not the worst thing, but I would introduce some balance in this portfolio. And in my opinion, now's a great time to have international exposure, to have emerging market exposure. One, they're much cheaper than US stocks on a relative basis. Two, a lot of people are looking for income. Most international companies, emerging market companies, have dividend yields close to 3%, maybe even a little over 3%. The dividend yield on the S&P is about 1.3%. So in a zero rate environment, a lot of people like income, they like dividends. That's a logical place to look. And then just as a professional investor, right, I'm paying attention to what's done well, but I'm also looking forward and saying, what's the future opportunity set look like for return profile? In other words, if I'm taking calculated risks today and I'm allocating my capital across various asset classes, what is likely to outperform, not yesterday, but in the next 3 years, in the next 5 years, in the next 10 years? And again, going back to the valuation story, emerging markets, international stocks are just much more attractive on a valuation basis. Now, that's been true for the last 5+ years or 6+ years. So while valuation is a nice metric to keep track of, right? Like you want to understand what you're paying for something, valuation is a lousy timing tool. So I can think something's cheap, I can allocate my money to it, and I could be right, but I might not be right for 5 or 6 years. And in the meantime, you're underperforming, if you're talking about international markets to US markets, for 5 or 6 years or a decade really, and it can become frustrating, but eventually that's going to flip. And I don't like to use hard and fast rules when it comes to investing, but valuation always matters at some point. So just keep that in mind. So it's a long way of saying I would find some balance. I would find some out of favor asset classes to invest in rather than shoveling money into what's done well. By over allocating to things that have done well, in my opinion, this risk reward equation is not favorable for this investor. What that means is they're taking on more risk as this portfolio has gone through the roof and gone higher. Future returns are likely to be lower, and the higher something is valued, the downside becomes more pronounced or could be more pronounced. And what often rises the fastest can fall the hardest. So again, just introducing some balance, being a little more intentional with our risk exposures, just to tighten up the range of outcomes a bit. And again, if I'm allocating capital for the future, I want to be mindful of that rather than looking at what's performed great and just investing in those companies. Another thing that sticks out to me about this portfolio is they have a decent amount in cash. And when I asked Bush about this, Bush said he was skittish about the markets. So he randomly woke up one morning, saw the markets, saw the portfolio was down, and sold about, let's say, 20-25% of his portfolio. So sold stocks and is just sitting in cash. Okay. And there's multiple problems with that. One, that's an emotional decision. That's not a repeatable process, right? Just waking up one day and looking at your phone or computer and saying, "Oh, my portfolio's down. I'm nervous. I'm gonna sell 20% of my portfolio." Okay. That is an emotional decision. That's not a framework for making decisions. That's a knee-jerk reaction. Bush might have felt good when he did that, right? I'm mitigating some pain. I'm taking some chips off the table. My portfolio is less risky. But I can tell you, it's a two-part equation. You sell, that's one decision, and you have to buy back in. That's another decision. And people get the second decision, when to buy back in, wrong every time, and they end up costing themselves money. So and I could go on and on about what else is wrong with that from a behavioral standpoint, but I'll save you from that. What would be better, and I would tell Bush, look, you've got 100% equities. If you're making decisions like this, jumping in and out and trying to basically time the market by selling stocks and getting back in when you feel better, you're not a 100% equity investor. You should not be invested in 100% stocks. 100% equity investor understands negative outcomes are a part of investing. They understand their portfolio is going to go down sometimes. That's the cost of admission. That's part of it. Being a 100% equity investor, you're going to have years that are uncomfortable and painful because you can't enjoy this here, plus 23% and making $300,000 on a $1.4 million portfolio without this on occasion. Okay. It just doesn't work like that. So I've said it before, but most people's problem when they're making these emotional decisions comes from shunning negative outcomes, shunning losses. That's part of the game. Okay, that's a natural part of investing. So as soon as you accept that, then you can be 100% equity investors because you understand all the potential outcomes. What I would tell Bush is, why don't you layer some bonds in this portfolio, or layer some alternative assets, or some gold, or some other assets to help tighten this up. Okay, so instead of negative 17%, maybe we make it so it's negative 12% as a potential outcome. Okay, so you might sacrifice some of the upside, but you're lopping off some of these deep losses, which make Bush uncomfortable. That's what I would tell Bush. You have to be honest with yourself. You're not a 100% equity investor. And then another thing I do for Bush is I would stress test this portfolio. So, I back to my earlier comments, a lot of people don't know how much risk they're taking because their advisors don't know how to show them risk, don't know how to show them drawdowns. They just show them performance. Investors only care about performance, and advisors only show performance. Okay, that's half of it. The other half is this. Okay, so when the stuff hits the fan and 2008 happens, how does Bush's portfolio react? Okay, we know how the S&P reacted. It was down about 37%. Portfolio that's 1.4 million would have lost 530,000. You can see even with Bush's 30% in cash or 25% in cash, Bush's portfolio is basically in lockstep with the S&P on the way down. Okay, the S&P is 100% equities. Bush's portfolio is 75% equities, and it's still getting its face ripped off, the same as the S&P. So back to my comment, this is not a favorable risk reward portfolio. Okay, if you have 25% cash, at the very minimum, you would want this loss to be 25% less than this. Okay, so instead of 37%, you might expect a loss of 25%. Like that would be more in line from a risk return standpoint, because again, you only have 75% equities as opposed to 100% equities here. And then we have some other scenarios that basically show the same thing, right? Peak to trough, financial crisis, the peak in 07, the trough, the bottom in 09. These big crooked numbers are pretty ugly. These are ugly as well. Some pandemic data here. So again, this portfolio is just not very efficient. It's out of whack. It lacks balance. Taking large sector bets. Risk reward is out of whack. And again, this person is probably just doing what people do. I mean, people like a winner. They like things that go up in value. They probably have seen Apple and Amazon doing really well, and they just shoveled money into that. And again, these people have been right. This allocation has been right for a good chunk of the last decade. But when it goes bad, it can go bad quickly. And part of our job is to help people build intentional, balanced portfolios, understand your range of outcomes, understand your risk exposures. It's not just about performance. And if you are a 100% equity investor, accept negative outcomes. It's part of investing. Nothing is broken. Nothing's wrong with you. Nothing's wrong with the market or your portfolio. It's just part of the cost of admission. So, you know, a lot of talking, a lot of probably redundant comments, but I think this is relevant because this is something that we see all the time. And again, we're just trying to help people make better, more informed investment decisions. So with that, I would be more than happy to look at your portfolio. You can ask me questions, submit a comment on our webpage. You can email insight@pureportfolios.com. That's Pure Portfolios with an S, and someone will respond to your question. We're all professional, credentialed advisors. We're not salespeople, and we just want to help people make better, informed investment decisions, help identify their blind spots and emotional and cognitive biases, because let's face it, money and investing is emotional, and we try to bring people back to the facts and educate them on sound investment principles and evidence-based decision-making, because there is a lot of noise out there. And part of being a good investor in 2022 is building an information filter, building trusted sources of information that you can rely on, filtering out all of the noise, because you're hearing like how to invest from TikTok, from Twitter, from Bloomberg TV, your neighbor, your brother, your sister. There's just a lot of misinformed people out there, a lot of misinformation out there. And part of our job as professional investors is building tight filters so we can take all that noise, filter it out, and get the signal from that noise to help us make better investment decisions. So thanks for tuning in. Thanks for watching. Would love to hear your feedback. Bye.